Hey guys, Andrew and Ray here with REH CPA, and a question we get asked a lot is, what are estimated taxes and when do I have to pay them? So Ray, what can you tell us about that?
So when you go to have your taxes prepared, right, and you owe, let's say, a substantial amount of money, you may have to make estimated tax payments. So how we calculate that is if you don't have, like through your normal withholdings or payments made in the IRS, if you don't have at least an amount deposited with them that is equal to 90% of your current year tax liability or 100% of prior year tax liability, then you will need to start making estimated tax payments. If you don't, you will have to pay a penalty. One of the ways to avoid having to pay that penalty is you meet your safe harbor amounts. That's a term that we use in the tax world it's called safe harbor, and it means you meet these requirements with the IRS to have a certain amount of money deposited with them to avoid having to pay any penalties. The safe harbor is to either have an amount deposited with them that is either 90% of current year taxes due or 100% of prior year taxes. The 90% is kind of a hard number to hit because you don't know exactly where you're going to be. With some good tax planning, we can get close. Or the 100% of prior year, which is a given because you know that number. Now that 100%, that depends on your AGI, right? If your AGI is over 150,000, you now have to do 110% of prior year. Right. Now that's 150,000 AGI for a married couple. It's 75,000 for a single individual. So once you cross that AGI threshold, that 100% of prior year tax goes to 110% of prior year tax. So if you owed a bunch of money and you're trying to hit those safe harbors through estimated tax payments, then those are going to be due quarterly. Your first one is due April 15th. Your second one's going to be due June 15th. The third one's going to be due September 15th, and your final one's going to be due January 15th. Now, if, let's say, you miss those estimated tax payments or you don't make them, then what the IRS is going to do is they're going to charge you a penalty. And what that penalty is, in effect, is just kind of an interest rate that they're going to charge you for not having paid that. A lot of clients will say, am I required to do this? Well, you're not required to, right? Yet, the IRS could get to the point to where they force some things, but it's generally a voluntary thing. And we like for clients, if they have big balances due, we like for them to make these estimated tax payments because we don't like you owing a lot of money come year end. We like for you to have your tax balance paid the year in which it is earned. Because if you wait until the next tax year, then it's kind of a compounding thing where you not only do you owe for the prior year, but you owe for the current year as well, and you're constantly playing catch up. So we like to utilize estimated tax payments to make sure that you don't have a lot due come tax time. So we do a lot of tax planning around creating estimates for people. So, if you've had some large balances in the past and you want to know how we can help you lower that, by all means, give us a call and we can help you with that.
Yeah, so that's a really good point, Ray, to make sure that people are paying their taxes based on current year profits.
Yeah, get it paid all throughout the year.
Behind. We see people all the time get behind on their taxes, and you want to make those estimated tax payments if you can, get that money in there, and to avoid any penalty and interest from accruing, and also just to make sure that you're staying ahead of the tax game.
Right, because if you wait until April 15th and the balance is due, so let's say you end up owing $50,000 on April 15th, well, not only do you owe that lump sum then, but then you're also supposed to start making your quarterly payments on April 15th, so now it's kind of a double whammy. So we like to get people straight to where they don't owe a lot of money come April 15th, and they're making their estimates regularly. That way they don't get into trouble with the IRS and owing them money.
Yes. So what if your income actually drops and you've been making your estimated tax payments all year? What then?
Well, if you catch it during the year, you can actually adjust your estimates, right? But let's say you continue making those estimates and your income did drop. Well, then you're going to be in a refund situation and you'll get the money back. You can even actually, if you have that refund, you can apply it to your first quarter estimate if you like, or your estimates for that year. Yep. So there's a bunch of options there. But at the end of the day, it's your money, right? It's your money and the IRS's money, but but if you if you pay in too much, you will get that back come tax time. But that's why we do tax planning for a lot of folks. is that we will see how they're running for the year and whether or not we think they even need to make that final estimated tax payment. A lot of times they don't have to, and sometimes we have to bump that last estimate up. So good tax planning really helps with that entire process.
Yeah, so as we're recording this video, we're about halfway through the year, so we're starting to shift towards that tax planning phase of the year. So give us a call if you have questions on this.